don't think that they're in a bubble, gold and silver. I think they rapidly revalued from kind of structurally undervalued to something closer to resembling fair value. So I'm less interested in them because they're less asymmetric than they were several years ago when they were kind of close to their mining costs and they were kind of super cheap based on many metrics I look at. They've revalued higher. I think we probably have not seen the high, but I think the speed with which they go up there is kind of behind us. And I think like I said, all the fast money is out of Bitcoin. A lot of the indicators look really good. I mean, the funding rates. If you're getting paid to short it or go long it, the on-chain stuff, the kind of the technical indicators, like if you look at say the weekly numbers, they're kind of rolling up. And so in my base case, you can always be wrong in these things. My base case that Bitcoin has seen the bottom. It's already up pretty significantly from the bottom. And I think this is an accumulation phase.
In a market driven by emotion, clarity is your only real asset. Subscribe to keep your thesis sharp and stay ahead of the macro shift. You just heard one of the sharpest macro minds in the world say the US debt spiral has no way out except default. And then, in the very next breath, she called the Bitcoin bottom. Those two things aren't a contradiction. They're the same trade. My name is, and if you've been sitting on the sidelines waiting for clarity on where Bitcoin goes from here, the next 20 minutes might be the most useful thing you watch this week. Lyn Alden is the kind of analyst who doesn't need to shout. She's been bullish on gold since 2018. She called the regional banking crisis before it broke. She predicted the multipolar currency shift years before it became a mainstream talking point. And when she says something quietly and without qualification, you pay attention. So here's the setup she's describing right now. US debt is at $39 trillion, growing by roughly $2 trillion a year. And Lyn's base case isn't that it gets fixed. Her base case is that it doesn't. That the fiscal spiral the US is in keeps going deep into the 2030s. Not a collapse, not a Weimar moment, but a slow grinding debasement. The kind that doesn't look like a crisis until you check your purchasing power 5 years later and wonder what happened. And here's where it gets interesting for us. That kind of environment, persistent above baseline inflation, structurally weak currency, bonds melting, equities expensive, that is the exact environment where scarce, liquid, affordable, self-custodial assets do well. She's not saying Bitcoin wins because of vibes. She's saying it wins because everything else is losing. She's also tracking something specific right now that a lot of people missed. When the war broke out, most people expected gold to surge and Bitcoin to get crushed. The opposite happened. And Lyn has a very clean explanation for double why. It comes down to one word: liquidity. Bitcoin had already shed its fast money. Months of downside had already washed out the leverage. By the time geopolitical pressure hit, Bitcoin was sitting in strong hands. And the war, unlike previous crises, didn't trigger a dollar shortage spike. So there was no forced selling. Combine that with strategy aggressively accumulating through the bear market in ways they couldn't in 2022, and you've got the setup she's been watching form for months. Her read? Bitcoin has seen the bottom. We're in an accumulation phase. Now she's careful about it. She acknowledges you can always be wrong. But when Lyn says base case, that means something. This is the same analyst who was bullish on gold at 2000 and watched it go to 5,000 faster than she expected. Her record on big structural calls is hard to argue with. What she's saying right now is that the next leg of demand for Bitcoin isn't going to come from retail. It's going to come from high net worth individuals, corporations, and a slow but steady rotation out of assets that are gradually losing their purchasing power. Gold just ran 20 trillion in market cap in a few years. And she's pointing out that the same forces that drove that rotation are still very much in play. You're about to hear it directly from her. Specific, grounded, no fluff. Here's Lyn Alden.
It's hard to say exactly what happened, but I would say that from my perspective, because people were surprised that, for example, from the start of the war, Bitcoin outperformed gold, which, if you polled people ahead of time, we have a straight up Hormuz closure, a war with Iran, it's ongoing. Which one outperforms? The vast majority of people would probably say gold. I think a really big factor was that going into that, gold had a lot of fast money in it. It had a very good 18-month period. It was gold and silver were kind of going vertical, and they were correcting a little bit ahead of time, but in general there's still a lot of fast money in them. And whenever kind of war or unexpected things break out, there's often deleveraging. And just kind of a little bit of a liquidity squeeze here and there. Whereas Bitcoin by that point had already had kind of a kind of two-phase down bear market, had been kind of rolling over for months. And a lot of the fast money was already out. And a lot of the leverage was already kind of liquidated from some of those really big down moves that preceded it. So by the time the war breaks out, it's mostly held by really strong hands at that point. In addition, when we look at kind of, just global measures of liquidity, they're not amazing at the moment, but they're not as bad as you'd expect from almost 8 weeks of a Strait of Hormuz closure, an energy crisis, and war. They've actually kind of held up better than one might expect. And while it's not always the case, I mean, Bitcoin tends to correlate with liquidity pretty closely. At least it's one of the major input variables among a few others that tend to kind of correlate pretty well. And that's been holding up. So I think the combination of fast money's already out, it's already kind of washed out. And then we have, decent liquidity conditions, and then Strategy's been kind of tuning their stretch product. So they've been able to kind of raise. They had trouble buying much Bitcoin in the prior bear market. So for anyone kind of following that, they bought a lot in 2021, but they didn't really buy much in 2022. And it's not because they didn't want to; it's because they just didn't really have the mechanisms to do so. But they've been able to kind of tune the knobs differently this cycle. So they've actually been kind of more rapidly accumulating recently, which all else being equal does put some upward pressure on the price.
It's interesting that we've had two moments of what you might call systemic pressure or near contagion with the banking crisis of about 2 or 3 years ago, Silicon Valley, Signature Bank and the like, where Bitcoin suddenly out of nowhere gained a lot of strength and started surging. And now we're seeing that in the middle of a war. Do you think that sometimes it takes an event or two before narratives shift and they suddenly take on a strength of their own? Do you think we're in the process of witnessing Bitcoin forging a new narrative as a safe haven, or is it still business as usual for Bitcoin, where it's still a speculative asset and it still more or less trades in line with other tech stocks?
I would be hesitant to talk about kind of a new narrative. I mean, it's one of those things because it's a self-custodial, portable, liquid, money. It does have risk-off characteristics, but just because it's a 17-year-old technology, it's still not widely understood by traditional finance. It's still small in the grand scheme of things. Many large pools of capital still treat it as risk-off. There's a couple caveats around, and I've had discussions with some institutions actually on this about why most crises Bitcoin tends to not do great for the next couple of weeks. It tends to be a risk-off asset, but a handful of crises it does well. And the kind of the main one they would point to is that regional bank crisis of spring 2023. And my kind of point there, again, it comes down to liquidity, which is that there are certain types of crises that when they occur are very negative for liquidity. And you can see that, for example, in, say, the dollar index spiking. That's like a sign, especially when it happens very quickly, that there's a sign of global kind of dollar shortage. And so, I mean, a key example was really early in the COVID lockdown sell-off. You have the dollar spiking. Even the treasury market went illiquid. Stocks, precious metals, Bitcoin, everything straight down until basically hyper stimulus came in. Whereas when we had the spring 2023 regional bank crisis, it was actually it was a pro-liquidity crisis in the sense that as soon as it broke, all market participants understood that the Fed was going to basically come in that weekend. And that there's really there's a little bit of Bitcoin weakness in kind of the days or maybe the week leading up to that. And that's because that's actually when a little bit of the liquidity was happening. And then once it actually happened, there was ironically a pro-liquidity event. Basically, the entire market reset its expectations of what rates are going to be because the Fed is kind of trapped now. They can't really continue being as hawkish as they were with this going on. So there was more dovish expectations immediately priced into the market. And they expected, and they were right, about getting very quick Fed and Treasury action. So that was ironically a pro-liquidity event. And normally, if you ask people, okay, we're going to attack Iran and close the Strait of Hormuz, most people would expect that's a negative liquidity event. And in past cycles, that possibly could have been the case. And this time it wasn't. There really was no spike in the dollar index. There's no major sign of dollar liquidity shortage of kind of the various indicators that I track. And so while there has been obviously some turbulence, the stock market went down for a little bit and it kind of rolled back up, even though the Strait is still closed. Overall liquidity conditions are fine. There's not a lot of kind of forced selling. I guess that's kind of how I would describe a liquidity squeeze. That there's often forced selling, and usually Bitcoin does really bad in that environment, especially if it happens over a weekend, because if they expect that they're going to have to sell on Monday, and you're a large pool of capital and you're kind of stuck. Well, if you can short Bitcoin, you can sell any Bitcoin you have 24/7. So you can sell it on a Sunday evening if you want to or have to. And so I think it's often kind of like it kind of has the unfortunate role of like the biggest thing that trades 24/7, and that is perceived as risk off. But in some of these exceptions, it's because liquidity conditions kind of held up better than one might expect. So in a pro liquidity crisis, it actually does pretty well more often than not. Seeing that correlation, I would say that, the sample size is not super big. When Bitcoin's a 17-year-old asset and you say, okay, well, the first 7 years it was tiny, so let's say a decade of correlation. That's not a ton of sample size to go on, but it makes some intuitive sense that you have kind of the hard money folks. There's fractured into a couple different camps. There's Bitcoin, there's gold, there's silver, there's like altcoins, and when one is doing really well, it tends to suck some of the capital out of the room for everyone else. Whereas when one is stagnating, it allows those other ones kind of a chance to do well. And so, because there was a pretty big central bank bid for gold. In addition, it was just kind of, a lot of us in the, I'm one of those people that's bullish on both Bitcoin and gold. So I've been tracking gold. I've been bullish gold since 2018, and a lot of times things happen all at once. Like I would have expected gold when gold was like 2,000. I expected it to be more like 3,000, but then suddenly it goes from like 2,000 to like 5,000 way quicker than I would have guessed. Like when it was 5,000, I would have thought that it would have been 3,500 or 4,000. So these moves tend to happen very quickly. In my view, the sentiment in precious metals has probably topped. Not to say that the prices have topped. I'm kind of on record saying I don't think that they're in a bubble, gold and silver. I think they rapidly revalued from kind of structurally undervalued to something closer to resembling fair value. So I'm less interested in them because they're less asymmetric than they were several years ago, when they were kind of close to their mining costs and they were kind of super cheap based on many metrics I look at. They've revalued higher. I think we probably have not seen the high, but I think the speed with which they go up there is kind of probably behind us. And I think like I said, all the fast money's out of Bitcoin. A lot of the indicators look really good. I mean, the funding rates, if you're getting paid to short it or go long it, the on-chain stuff, the kind of the technical indicators, like if you look at say the weekly numbers, they're kind of rolling up. And so in my base case, you can always be wrong in these things. My base case is that Bitcoin has seen the bottom. It's already up pretty significantly from the bottom. And I think this is an accumulation phase.
I quite often hear the question being asked, where is the money going to come from to get Bitcoin to tens of trillions in market cap? And then we see, an asset like gold go from 10 trillion to 30 trillion in the space of about, 3.5 years. Yeah. There's clearly, the world is awash in cash. It's just, it needs a narrative and a reason to allocate to Bitcoin. Where do you think the money will come from? What kind of investors will allocate to Bitcoin next?
Good question. I mean, so there's hundreds of trillions of liquid assets in the world, and so 30 trillion like gold starts to get kind of big, but it's still actually a pretty small percentage. Something like Bitcoin, when it's 1 trillion or 2 trillion, it's tiny. A lot of it is in the bond market, and a lot of it's in the currency market, and then a lot of it's in the equity market. There's kind of the biggest pools of liquid capital, and then of course the illiquid real estate market is massive. So when you add everything together, I mean, you get estimates that are kind of around like $1 quadrillion of kind of total dollar-denominated capital out there. And it doesn't take a lot of that to want to flow into an asset to make it go up. I mean, another example along with gold is like Nvidia, a single stock going up to like a 5 trillion market cap, for example. And so, things can absolutely move quickly. My kind of base case where demand's going to come from, I think it's going to largely come from the high net worth and corporate side. I think there has to be ongoing kind of education and companies and technologies making it so that retail can access it. Because I think, from a kind of a cultural standpoint, that's the most important people we want accessing it. But what actually is going to move the needle in, say, the next 2, 3, 5 years. I think it'll be corporations continue to buy it. I think it'll be, you do the math on how many billionaires there are in the world and how many of them have any meaningful amount of Bitcoin. I think that'll increase over time. I think kind of the appreciation of one, portable capital, just portable, liquid, potentially self-custodial capital is really attractive. It gives the holders optionality to make permissionless payments. And then when they look around and say, okay, equities are kind of expensive, bonds and currencies are gradually melting down everywhere. Gold and silver just ran up a ton. The other really big option is Bitcoin. So I think it kind of over time continues to slowly gather just a little bit from many different types of larger assets. And it doesn't, if it takes a couple percent from multiple major asset classes, that's how it can go up something like 10x over a long period of time. It's no longer a growth industry. And it never really was. It's just that now it's kind of being marked to market. And so if you kind of look at, I think you can kind of measure this in terms of narrative exhaustion. So the really early wave of altcoins was like alternatives to Bitcoin. They're saying, hey, the Steelman case of them is, hey, did we get the block size right? Did we get the speed right? Did we get the privacy settings right? Let's throw some alternatives at the wall and see what the market picks, right? That's kind of the early phase. Then there was the ICO one, basically saying, oh, we can just go around the SEC and issue our own securities and then get potentially sued. So that was like the second wave. Then there was the DeFi wave, which is still a really big narrative, but it's actually remarkable how compressed the initial one was. So it kind of really emerged at scale in mid 2020, DeFi summer. And then by late 2021, it hit its peak total locked value and still hasn't quite reclaimed that figure 5 years later, right? So it's really only had a year and a half bull market, and then it's just been 4.5, 5 years of stagnation. And as NFTs, as you mentioned, were another narrative that kind of came soon after. That was kind of a flash in the pan. They still trade, obviously, but they're nowhere near the liquidity and size that they were. Then there's been a little bit of a resurgence in privacy coins for a while, which I think that's kind of over now. We'll see if that that could have another round of legs to it. Meme coins had a couple attempts, and kind of this last cycle, there really was no narrative. The narrative was kind of meme coins. And I think that's almost like the final cycle, where it's like you don't even pretend that there's something innovative here. It's just like it's basically player versus player competition. And I think just now people rightly kind of associate crypto with scams or scam adjacent, kind of like Ponzi adjacent, scam adjacent. And I think just the overall kind of value of that space is minimal. I think Bitcoin is valuable. I think stable coins are doing something for a lot of people that they want dollars. They want digital payment rails and dollars. I think there's some legs for tokenization, meaning that if you can tokenize gold, which people have been doing since at least 2018, it's kind of like a global ETF in a way. It's an ETF that you can have almost regardless of what country you're in. Tokenizing major stocks. For people that want it, it's harder for them to get access to their own country, and they want either an S&P 500 token or an NVIDIA token, or But I think beyond either tokenizing a handful of those kind of real things, and Bitcoin, I'm not really bullish. It's not really else I see that I'm bullish on, nor have I been bullish on. I think it's going to continue to stagnate.
I think a lot of people were pushing the narrative that when corporations come, when Wall Street comes, that they will adopt the crypto native blockchains for their own ends. But what we're actually seeing is that a company like BlackRock, JP Morgan, building their own blockchains and for their own purposes. So that use case is not even bearing fruit. Larry Fink's made the comment quite a few times that he wants to tokenize everything. I don't quite understand what the benefit of it is. Is it geographic and jurisdictional unlock, or what? Like, is it additional liquidity because of the smaller unit to which you can tokenize an asset? Like, what's going to be the benefit? What's going to be the value unlock there? I don't understand it.
Often it's either faster settlement. So securities will often historically took days to settle, and over time that window has diminished to some degree. And then some wrappers are just more efficient than others. Like, for example, ETFs have gained a lot of market share compared to mutual funds because they're just a much more efficient wrapper. They're even more tax efficient. And so kind of like how stable coins, I mean, anyone who sends international wires on a regular basis and how opaque and slow and even expensive that process can be. It's like, hey, here's some stable coins or something. There's certainly innovation unlocks you can do with some of this technology, but like you said, I mean, a lot of them can do it in-house. A lot of them don't like the idea of irreversibility. Kind of the whole
Hmm.
point of a fiat payment is that a lot of them are reversible should you need to. That's kind of the whole point of a custodial, or just it's all fake money anyway. It's all fiat, so you can just kind of reverse stuff. Um, and they don't really want irreversible payments in things that they have any degree of liability or control over. So, to the extent that they use blockchains, they might just mean they want federated networks, things that have that kind of. It's almost just like a database. It's like a little bit more auditable, or a handful of players can all kind of see parts of it more so than just kind of internal analog systems. But yeah, I don't think it means like a given crypto token takes off because 30 different financial institutions decide to use it. Anytime value accrues on one, uh, I think like banks are going to try to capture that wherever they can, and only really big network effects can keep them away. Like, for example, the stable coins have some degree of network effects because, again, liquidity begets liquidity. So really, other than liquidity network effects, or in proof of works case, security network effects, or like device or other types of kind of like like network effects, um, I just don't think there's really much legs to it.
So there it is. Lyn Alden's full picture laid out without noise. The debt doesn't get fixed. The dollar keeps losing purchasing power. Bonds and cash keep melting. And into that environment, you have Bitcoin, an asset that's already been wrung out, that's sitting in strong hands, that's being quietly accumulated by corporations and high net worth capital, while most retail investors are still on the sideline debating whether the bottom is in. She said it plainly. Base case, the bottom is already behind us. Now, a few things I want to call out that I think deserve more attention. The liquidity framework she described is something most people completely miss when they try to explain Bitcoin's price moves. They say war broke out, Bitcoin should crash. But Lyn's asking a more specific question. Does this crisis create forced selling? Does it spike the dollar index? Is there a liquidity crunch that makes large pools of capital sell everything liquid on a Sunday night? In this case, the answer was no. And that's why Bitcoin held and then climbed, while gold, with all its fast money still loaded in, actually had more vulnerability in the short term. The second thing worth sitting with is what she said about the broader crypto space. She didn't hedge it. She basically called it a stagnating industry. Meme coins as the final narrative. Player versus player. And then she drew a clean line. Bitcoin. Stablecoins. Maybe some tokenization of real assets. Everything else, minimal value. That's not a new position for Lyn, but hearing it stated that directly in 2025 is useful context for where to focus your attention. And the third thing, the one that I think matters most right now, is the rotation signal. Gold went from 10 trillion to 30 trillion in market cap in about 3.5 years. That's $20 trillion of new capital finding a home. Bitcoin's current market cap is still a fraction of that. Lyn's base case is that a small percentage of the hundreds of trillions sitting in bonds, equities, and currencies, capital that is slowly getting diluted, slowly losing purchasing power, starts looking for a way out. It doesn't need to be a flood. It just needs to trickle consistently toward the one asset that can't be debased. That's the trade. If you found this useful, the most valuable thing you can do right now is hit subscribe. We do this every week. Deep analysis from the people actually worth listening to. No hype. No price predictions for clout. Just signal. If you've got a position already, Lyn just gave you a very solid framework for why you hold it. See you in the next one.